Happy Monday and welcome into Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith. We had some technical difficulties this morning, so thanks so much for sticking with us. But here we are, just about 20 minutes until the opening bell on Wall Street, and Brad is certainly set up to be a very busy week for the markets when we've got Jay Powell testifying on Capitol Hill starting on Wednesday, Super Tuesday tomorrow on Tuesday, and then the jobs report on Friday.
Better late than never here. Busy week ahead, busy show ahead as well. Let's kick things off with just a check of the futures. Taking a bit of a breather here. We have been higher for 16 of the last 18 weeks here. So taking a look at the Dow futures, you're seeing that lower by about 0.5%. Nasdaq 100 futures right now flat, just barely to the downside, and the S&P 500 futures down by about 0.25%. For the S&P 500 as well, it's noteworthy for some FactSet data out there. The percentage of beats for both the top and bottom line earnings here are actually running below some 5-year average. We're going to get even more earnings in the form of Kroger, Target, Ross, and Costco. A little bit more of a read of the consumer over the course of this week as well here.
Yeah, well, Brad, the stock rally that we have seen play out in the markets looks to be set for a pause here at the open. Like Brad just said, we have the S&P futures under a bit of pressure here ahead of the open. But despite all that, we've got a very bullish call out from Bank of America, Savita Subramanian there, raising her year-end target for the S&P. Josh Schaefer has the latest on that for us. Josh.
Hey, Shauna, yes, Bank of America coming out and raising that target for the S&P 500, moving the year-end target to 5,400. That's up from a previous call of 5,000. They're really the fifth firm that we follow at Yahoo Finance over the last month that has moved up their target on the S&P 500. So this has been a clear trend here. Bank of America's call for 5,400 now sitting atop among the different targets that we track here in line with UBS, also sitting at 5,400. And a pretty similar call here to what other strategists are saying. Bank of America's had a positive outlook on earnings. They feel like earnings are on the upswing here and earnings are going to continue to do well. Also should note Bank of America's economics team, which the strategy team relies on to understand what's going to happen in the economy, came out last week and said they now think 2024 GDP is going to be better than they initially expected. So guys, kind of the overall call here is just better economy than maybe we thought, earnings doing well. That's a pretty solid backdrop to own stocks. Also, should just mention, we have the S&P above 51,000, right? So at some point, people got to move up targets.
Is there one clear outperformer that they're also putting out there with this target update as well here?
I wouldn't say there was a clear, necessarily outperformer that I saw in here, Brad. One thing that I did think was interesting was just taking a look at what they call euphoria, right? And that's sort of one of the biggest parts of these calls we're seeing right now is, have we reached euphoria? Bank of America is saying bull markets end with that euphoria and we're not there yet. Sentiment has improved, but areas of euphoria are limited. They highlighted AI and GLP-1 as maybe areas we're starting to see euphoria, but not necessarily maybe we're all the way there. And they essentially said they feel like we're going to be in a more euphoric moment when areas outside of AI and GLP-1 start contributing and we see valuations as a whole rise, which is something we're seeing a lot of people highlighting right now.
All right, Josh, thanks so much for breaking that down. We certainly are no shortage of news here, headlines coming out this morning. We got to talk about what is on your screen right now, and that is Apple. Big headline out saying that Apple getting hit with a nearly a $2 billion fine from the European Union. This is all over claims that has shut out music streaming rivals like Spotify. Alexis Keenan joining us here at the desk with the latest on that. Alexis.
Hi, yeah, so this is a monster fine against Apple by the European Commission. That is the antitrust regulator there, $1.95 billion to be exact. And this is for allegedly, and now the European Commission concluding, that Apple illegally used its dominance in the market for distribution of music streaming apps, favoring their own services over rivals. How they did that, the European Commission says, is by blocking app developers from fully telling iOS users about music subscription services outside of the App Store, how they could access those, and also by outright banning developers from adding pay links to get these services elsewhere. That then forced these app developers, these users, to go ahead and purchase through the App Store and pay that 30% fee that comes along with ordering services through that avenue. Now, Apple is expected to appeal. This is the first antitrust penalty against Apple by the EC. Apple coming out also with a post on its blog, really criticizing this decision, saying that today Spotify, which is the company that brought this complaint 5 years ago to the EC, saying that they have a 56% share of Europe's music streaming market. That's more than double their closest competitors, Apple says. They say the decision was reached despite the Commission's failure to uncover any credible evidence, Apple says, of consumer harm. They go on to say that the EC ignores the realities of a market that is thriving, competitive, and growing fast. Guys?
All right, Alexis, thanks so much for breaking that down. Let's talk more about what we have seen play out in technology. Many of those stocks really leading the rally that we have seen over the last several months, over the last year and a half, and especially since the start of the year. We talk about the Nasdaq ending Friday at a record high. A lot of that being fueled by the excitement surrounding AI and what we have seen play out there. So we want to bring in Mark Mahaney. He's Evercore ISI's managing director and head of internet research. Mark, it's great to have you here. So I think a lot of people are watching the massive run-up that we've seen in a lot of these tech names, many of the ones that you cover, and are asking themselves whether or not we're starting to see a bubble form. What do you think?
I don't think so. And good morning, Shauna. I don't think we're seeing a bubble. There's clearly a lot of interest. There's just a heck of a lot of capital going after the space by the companies themselves. I just think about if I were to add up the CapEx spend by companies like Google, Microsoft, Meta, and Amazon, I think it's about 150 billion. And not all of it's going to generative AI, but a material amount of that is. And so I'm struck by the fact that you have four of the most profitable companies out there with the biggest balance sheet spending, hard-earned money investing in something. And Nvidia is clearly a beneficiary of that. There are other platform or infrastructure plays on that too. And then their application layer wins off that too. And I think the market's sort of been less focused on that. I think those opportunities are out there. So no, I don't think it's a bubble. I also look at valuations. If I just stick with my knitting in the stocks I look at, I look at Google and Meta, both of them trading pretty close to a market multiple. A couple of turns above an 8. These are big cash flow machines. Amazon's got a premium multiple, but I think its growth probably warrants that. So I just don't see the 100x PE multiples, and I've lived through some of these bubbles before. I just don't see that now. So I think there is a real trend out there, and I think generative AI is going to have vast and broad diffusion across a lot of different places, bringing down costs and helping with new product introductions. So I think these companies are right to invest in this space aggressively, and I think investors are right to buy some of these assets as long-term plays off of this trend.
Mark, as we are showing the Wi-Fi Interactive right now and thinking about some of the early winners in the generative AI hype phase and now what's turned into a show me story, at least on the chips front and a few of the other areas of that generative AI trade, where do you believe we'll start to see some of the tangible assets that the end users, the consumers can expect to come their way in the form of applications, and who are some of the biggest beneficiaries there from a stock price action perspective that you're going to be tracking?
Well, the biggest one I've seen at the app level, if you will, is actually Meta. I think Meta's been using AI to fine-tune, actually to rebuild its ad tech stack post the Apple privacy changes. But on the user side too, I mean, if you use Instagram and Facebook, over the years you've seen a pretty dramatic change just in the last 2 years about what your feed looks like, and that it's got content from across the internet. It's not just friends and family content anymore. And there's a lot of AI that goes into making sure that content is as relevant and as focused on you as a person. And then for advertisers, it's done, they've had to completely rebuild their ad tech stack, but they did in a way that, and did it without having to track, without the need to track individual users using, probabilistic techniques to try to figure out what would be the best ad to put in front of you that'd be most relevant to you and to the marketer too. So I think we've had a wonderful example right in front of us of a company that's been using it to actually get the best growth rates now in internet advertising and at scale. That's what's truly impressive about it. Company talked about investing aggressively in AI. People were sort of dismissive of that, but I think it's paid off for them in spades. And I think the stock is still reasonably priced.
Yeah, Mark, I want to ask you about the pricing right now. That valuation, despite the massive run-up that we've seen since the start of the year over the last 18 months, is that valuation still reasonable?
Well, on Meta, I'm trying to quickly check here. I think I've got it trading at 21, 22 times earnings. Mm-hmm. So, you tell me 21, 22 times earnings, try to be thoughtful about it. I want a growth rate that I think is somewhere like 20 to 25%, but I think that's what Meta gives you. I think they're going to be able to do. I mean, right now they're doing more than 20% year-over-year revenue growth. I'm sure that'll fade over time, and I know the comps get tougher in the back half of the year. But you probably have a solid double-digit, call it mid-teens revenue grower with margin expansion, with material share buybacks, and now with the dividend. You put all that together, and you've got a 20 to maybe even as high as a 30% earnings CAGR. So I think that well warrants the current multiple that the company has. And I just think this newfound cost religion that I'm finding across a lot of tech companies, not all of them, but across a lot of them, I think that really has given Wall Street a lot more confidence that these companies are being maturely managed. That's a big change. This was a sector that was built for growth, run for growth. Now it's being run for profitable growth. I think it makes it much safer, much better area for investors to invest in.
Mark Mahaney, Evercore ISI Managing Director and Head of Internet Research. Always a pleasure to get some of your insights. Thanks so much for joining us before the bell. Appreciate it. Well, everyone, let's switch gears here. Bitcoin making its way towards record highs as it surpasses $65,000. Yahoo Finance's Jared Blickery standing by with this one at the Wi-Fi Interactive. Hey, Jared, what are we seeing right now?
It is happening. It's almost there. Look at this. Bitcoin up another 4.5% over the last 24 hours. This is a 5-year chart. And let me put candlesticks on so you can see the actual ultimate high right around 69,000. Some exchanges will say 70,000, but we are right there at the Rubicon. And one interesting stat I just came by, 97% of all Bitcoin addresses, and this is a study of the blockchain, of all Bitcoin purchases are in the green now. And I think that makes sense. You'd have to buy, what, at 66, 67,000 way back in the day for you to be underwater. But I think we're going to be wearing our Bitcoin 70,000 hats and then 100,000. So something to think about there. Another thing I've noticed over the last few days is we've seen a rise of the altcoins. Some of the coins that are fringier than Bitcoin and Ethereum. We got Shiba Inu up 100% over the last 5 days from really low levels. Bitcoin Cash, Dogecoin, haven't looked at that in a while. So we're seeing lots of other parts of the market catch up. This tends to happen at the end, but hey, maybe it's at the beginning this time. We'll have to see how far this momentum can take us.
We will. We're going to be talking a little bit more, later on in the show about that momentum that we've seen and how much rally, or whether or not this rally still has legs. Jared Blickery, thanks so much. Let's get to the latest on JetBlue and Spirit. JetBlue abandoning its $3.8 billion deal for Spirit. Now, Spirit is going to receive $69 million. That's because of outstanding matters being resolved here. Now, this resolution, or this decision, I should say, comes after Carl Icahn obtained those 2 board seats on JetBlue's board. We are seeing some action here in pre-market trading on JetBlue and Spirit. And Brad, not necessarily a massive surprise given the ruling that we had on this merger here. But again, I think the larger question is what this means for future mergers, not only within the airline space, but maybe some of the regulatory pressure that we could see across the board throughout industries.
Yeah, absolutely. Under this agreement, actually, JetBlue is going to have to pay Spirit about $69 million, and the termination kind of resolves all outstanding matters related to the transaction. But it's a huge day and a shock in the system, I think, for some of the ultra low-cost carriers who are trying to figure out, in this consumer environment, more demand for premium, more rebound in corporate travel, which tends to skew back towards that premium part of the broader travel industry and assets that are available there. What that means for some of the ultra low-cost carriers that are trying to figure out both route schedules, they're trying to figure out exactly what the experience looks like and feels like for those consumers, and the pricing at which too. And so that's something that's going to be interesting to see how JetBlue, Spirit, and even Frontier continue in their go-forward strategies, everyone.
All right, we'll keep right here on Yahoo Finance. Much more ahead. Coming up next, we're talking Macys. ARK House raising its bid for the troubled department store. We're seeing shares of Macys rally here ahead of the open. More on that when we come back.
An activist investor group looking to buy Macys raised its offer on the retailer to $24 a share from $21 a share, pushed the valuation to $6.6 billion. Macys rejected the original bid from Arkhouse Management and Brigade Capital Management back in January. Yahoo Finance's Brooke DePalma has the details on this one. Hey, Brooke.
Good morning, Brad. Good morning, Shauna. That's right. This is the second offer from activist shareholders Arkhouse alongside its partner Brigade Capital Management. So how exactly does this offer stack up compared to the previous offer that Arkhouse presented? Well, this is now $24 a share. That's a 14% increase from its original proposal. It's also a 51% premium to Macys share price on November 30th, 2023, when news originally broke out of that first buyout offer. It's also a 33% premium to where Macys shares closed on Friday at $18.01. Now, Macys did confirm in a release that it received the proposal and it will review it. And this is less than 1 week after Macys laid out its original growth strategy. And Yahoo Finance did get access to Arkhouse Management. We did speak to Gabriel Kahani last week, and he told Yahoo Finance that that growth strategy that Macys has laid out is simply not enough. He said that incremental changes related to digital display systems, merchandising, or even store closures have been tried before, and they're unlikely to deliver any material value to shareholders. They said that Macys have their eye on margin improvements. Where they're focused there, the company is melting away. Now, many speculated that Arkhouse is solely focused on the real estate. Arkhouse telling Yahoo Finance that they're focused on giving a premium return to shareholders, then the real estate and the retail business. And so we'll really see how this all plays out. Macys currently reviewing that second offer from Arkhouse Management, guys.
We're seeing shares rally here ahead of the open. All right, Brooke, great job. Thanks so much. Let's take a look at two other movers that we have our eye on. That's Supermicro and Decker Outdoors. We're taking a look at these two names because of the fact that they are going to be added to the S&P 500. That is as of the start of trading on March 18th. Both shares here rallying in the pre-market. Now Supermicro and Decker Outdoors are going to be replacing Whirlpool and Zions Bancorp. Now it is important to point out that both of these companies have had an extremely strong start to the year. You're looking at Supermicro, that stock up pretty substantially here, more than 200% just this year alone on some of that AI buzz. And then also, Brad, Decker's Outdoors is also an outperformer, up just about 35% since January 1st.
Yeah, tracking Supermicro here this morning. Pre-market, you're seeing shares move higher by about 15%. Decker, really interesting here. Decker's Outdoor, of course, that parent company of some of our home favorite brands, at least for your feet. But at the end of the day, the company, the UGG maker, I should mention, and that is one of the fan favorites for the feet out there. In the most recent quarter that we've been tracking, the company jumped, skyrocketed. Shares jumped about 15% off of some pretty significant record profit and revenue in that third quarter most recently here. And so as you're thinking about what's the sneaker, the footwear landscape is like, Decker's Outdoors really continuing to cement itself over decades at this point, that placing them firmly within this rotation that we're seeing within the S&P 500 as well.
All right, well, let's take a look at Disney. It is our stock to watch this morning. A call out from Morgan Stanley raising their price target on the stock to $135 a share from $110. Madison Mills is on the floor of the New York Stock Exchange. The latest on that, Maddie.
Yeah, Shauna, as you mentioned, this change to the price target up to $135 is based on a couple of things that I want to run through here. One of them being an anticipation of profitability within the streaming sector of the business. The other being an anticipated growth in the parks revenue. Focusing on that streaming part that I mentioned for a second, I think this could also be a sign that that joint venture between Warner Brothers, Fox, and Disney is getting a bullish view on the street. Now, having said that, I took a look at the Yahoo Finance Plus platform in the pre-market this morning. It looks like Disney is trading near the very top of its 52-week range. But if you're on the app and you scroll down a little, you can see news related to this name. And we can see that Blackwell's Capital did release their investor presentation to its fellow Disney shareholders this morning. This is one of the two activist investors pursuing Disney right now. And they talked about some of the headwinds that they anticipate in spite of this upgrade to Disney's price target that we saw this morning. They're talking about concerns about content and technology. The content piece feels particularly prescient right now given the extreme growth we've seen in a name like Netflix. How is Disney going to be able to compete with those other streaming giants moving forward?
All right, Madison Mills, thanks so much for breaking that down. We've been watching Disney here pre-market, still higher by about 1% right now. We're just seconds away from the opening bell here. You mentioned a lot of the economic data that's waiting to come out this week. Of course, on the employment situation front, I'm excited for some retail earnings, especially Costco, where you can go and get some oversized fish and some pesto butter.
There we have the opening bell. Oversized fish and pesto butter. We're going to dig into that in just a minute, but we got to take a look at this opening bell here. Again, stocks coming off record closes on Friday. We saw a lot of excitement still playing out surrounding the AI trade, fueling those gains that we have seen over the last several weeks and really since the start of the year. You've got TrueBridge there ringing the bell on the Nasdaq as we see confetti start to fall here. But again, a very busy week ahead. Like Brad was just saying, Super Tuesday, you've got Jay Powell testifying in front of Congress. And then we've also got that jobs report on Friday. Jared Blickery, Madison Mills still standing by with a closer look at some of the movement that we're seeing. Maddie, what are you hearing on the floor?
Well, it's interesting to see the markets muted open here because, as you mentioned, we saw another record-breaking week. Last week, we've seen 15 record-breaking highs in the S&P 500 this year, and we just closed out our second month of the year. So it's crazy to think about. On Friday, the rally was really driven by, no shock here, AI. That was after Dell's record-breaking earnings. That lifted TSMC over the course of the weekend, and that led Japan's Nikkei index to its all-time highs around 40,000 as well. I'm interested in this muted reaction that we're seeing this morning. We're also seeing that the 10-year is inching higher as well. That is an indicator to me that the market is a little bit more cautious as we head into a lot of the economic data that you guys mentioned we're going to have throughout the week. We've got Powell's congressional testimony coming up for 2 days this week, Super Tuesday, as you mentioned. And then, of course, we've got that jobs report on Friday. I think it's going to be really interesting to have a couple of days of Powell kind of defending the idea of higher for longer. And then we're likely going to get another jobs report. At least the estimate is that it's going to be another record-breaking jobs print. So what does that mean when we have this record-breaking strength in the labor market? And yet the Federal Reserve continues to keep rates higher for longer. That bifurcation in this economy is going to continue to weigh on Powell. That's one of the reasons in the analyst notes this morning we saw Gapin at Bank of America saying that Powell needs greater confidence to be able to cut. Andrew Hollenhorst from Citi also adding, shocking twist here, the Fed's going to need more data. Data dependent, guys, as always.
Data dependent. Where the data leads, the Fed will follow. All right, Madison. We've got a lot going on here today. Maddie, thanks so much. Jared, let's toss things on over to you at The Interactive.
You bet. Let's take a look here. Small caps, and I'm going to focus on the Russell 2000 here in a second. The only one in the green here, looking at some losses in the Dow, S&P 500, and the Nasdaq. Let me just show a longer-term chart. Here is a 3-year chart of the iShares Russell 2000 ETF. We are only now just breaking to the upside, and this has been something that we've been tracking for a while. We've had some breaks to the upside, then some retracements, and it's been very slow going. But is this the one? Is this the one that really kicks off that small cap rally that people have been waiting for? We'll have to see. Let's check in on the sector action for today. More red than green in the pre-market, and that is the case here. Industrials, materials, and healthcare, those are the only three in the green. Communication services and energy, those are trading to the downside. Comms are down about 1%. And I should mention, we've seen industrials and materials really pick up over the last few weeks. So it's not just about the tech, and it's not just about AI and Nvidia anymore. Having said that, Nvidia is at another record high, up 2% here. Alphabet and Apple, those have been weighing on the Mag 7, and Meta, add that to the list here too. Tesla underwater. But let me just show you a quick chart of Apple here, because it has broken some what was key support, and that would be 180. So it is now trading to the downside in territory that we haven't seen for a few months. And here's a 1-year chart. It looks like we're going to probably test this right here, and then that's when the rubber meets the road. So we'll have to see how that plays out. And then just checking in our leaders today, Bitcoin flying high. We did 65,000. We'll see if we can hit 70, even higher. Then we have New York FANG. That would be the Nvidia AI trade. Regional banks having an interesting day. They were among the laggards, the worst performers last week, but we're seeing them in the green here. Korean stocks, small oil, home builders, and defense stocks. So interesting mix here. China taking it on the chin. That is the worst off, down about 1.3%, guys.
All right, Jared, thanks so much for setting up today's trading activity, at least here in the U.S., and then also some of the activity that's closed overseas. Jared, appreciate it. Well, everyone, coming up, we've got much more on today's market activity. We've got a strategist joining us for where to cash into the rally. We've got more on this next.
We have U.S. stocks starting the week in the red, coming under a bit of pressure following last week's record-setting rally where we saw the S&P and the Nasdaq both reach all-time highs. A lot of this be on the back of that AI-fueled optimism here. Now, it is a huge week for the markets. It could be a big test. We have Jay Powell testifying down on Capitol Hill for 2 days, starting on Wednesday. Then we've also got the jobs print on Friday. So what will all of this tell us about the calculus for the Fed and when we could potentially see that first rate cut? We want to bring in Jack Manley. He's JP Morgan Asset Management's global market strategist. Jack, it's great to have you here. So how should investors be thinking about the current valuation levels with what's ahead and so much uncertainty surrounding that first rate cut?
Yeah, the current valuations levels, at least at a headline kind of aggregate level, are a little bit disconcerting. I mean, frankly, we're looking at the S&P 500 trading at almost 21 times forward earnings, which is well above the long-term average and well above what I feel seems to be like a comfortable kind of level. That said, the story that we've been telling for a very long time, and it's an earnings story, it's a price story, is that this is very much a story of divergence within the sector, or within the index, rather. You open up the hood, and there are some names out there that are trading at steep discounts, some names out there that are trading at extraordinarily high levels. So index-wide, I'm a little bit concerned, but I'm not particularly concerned about being an equity investor right now. I just think that the story has to be overwhelmingly an active management one, a security selector one. That's what I think is going to drive investor returns this year.
What would you be looking at to try and decipher whether or not, though, even with this AI run-up and hype that we've seen, whether or not we're approaching bubble territory, though?
Well, I think we have to remember, I mean, look, fair question, first of all, right? There is real temptation to draw parallels between what we're experiencing right now and what we were experiencing during .com. I don't want to bite on that, really. I don't think it's a particularly compelling argument because the companies that you are looking at right now that have done so extraordinarily well over the last couple of years are real companies that make real things and have been making real things for a very long time. These are not companies that popped up in somebody's garage a couple of weeks ago and rode the AI train higher. These are multinational household names. And that is a huge differentiator, right? Another important thing to consider here, Brad, is that when we think about some of these big names, their balance sheets are just rock solid. And so the interest rate environment just isn't as challenging for some of these names as you might initially anticipate, given where rates are and how they've sort of held higher for longer. So I don't think we're in bubble territory, and I'm not advocating that you were to, say, ditch the Magnificent Seven from your portfolio allocation moving forward. It's just about a broadening out of this recovery and looking outside of those largest sort of high-flying names to find those other names that will likely do better this year.
Where are you seeing that opportunity?
Well, a lot of temptation, again, to have conversations about style boxes. I don't really want to have that conversation because it's not growth or value. It's a little bit of both. It's even hard to have the sector conversation. I'm sort of neutral across the board. I mean, I suppose I like consumer names just a little bit better because the consumer seems to be doing pretty darn well. I suppose I like the bond proxies, REITs, utilities a little bit less because why go into a bond proxy when bonds look as good as they do right now? But again, this really is a security selection story over anything, Shauna. To me, the biggest overweight, the biggest factor that you want to consider is quality instead in allocation because money's not free anymore. And we're talking about the timing of the first rate cut. Even when rate cuts do start, we're not seeing interest rates go back down to zero anytime soon. And if money's not free, then you have to be thoughtful about how you're allocating capital. So reasonable valuations, those strong balance sheets that I was talking about, and sustainable, dependable earnings growth.
Do you feel like this is a consumer that is waiting on or kind of banking on rate cuts specifically to improve sentiment or to kind of add on to that resiliency that we've seen?
Let's put it this way. Lower interest rates aren't going to hurt the consumer.
Sure.
But what I think is important to remember is that interest rates very clearly have not hurt the consumer in the way that we thought they were going to initially. And I think that has to do with the composition of debt in this country. When we look at household liabilities within like sort of a consumer balance sheet, 70%, give or take, of household liabilities are in mortgages, and 90% of those mortgages are fixed rate, which means if you bought 2, 3, 4, 5, 6 years ago, you haven't been forced to refinance. And your monthly expenditure on, say, your mortgage hasn't budged a whole lot, which means that there is still a lot of cash out there sloshing around. There is still a lot of ability for these consumers to continue to spend.
Jack, always a pleasure to have you here in studio with us. Thanks so much for taking the time today.
Thanks, guys.
Jack Manley, who is the JP Morgan Asset Management Global Market Strategist. Everyone, coming up on the other side of the break, we've got much more Yahoo Finance Live. Stay tuned. Here's a live shot of New York. Crude prices are moving higher after OPEC Plus announced plans to extend production cuts until June. The group began cutting over 2 million barrels per day back in November. To break down what this means for investors, Neil Dingman, who is the Truist Securities Managing Director, here with us. So ultimately here, how could we continue to see this have a broader impact on energy prices, or is it largely baked in at this point?
I think, good morning, thanks for having me. I think, number one, it is largely baked in. I think we continue to count on not only the 2 million, it's really Saudi continue to step up. And I think what's interesting is Saudi continue to push out their 1 million cut that Russia is going to exchange. And actually, right now, their cut actually contains a large amount of exports. It's actually going to be all production. And so I think just to see the confidence maybe extend out next time more than a couple of months, I think will give us a sense that this sort of support is here to stay for some time.
Neil, does this put a floor in for oil prices? And what would that be? And when we talk about maybe some of that upside that we could see upward pressure as a result of this, how much higher could we see prices go?
Yes, I think, number one, it does create a floor. I think you take this, couple this with very, very limited domestic supply. I think that's what surprised folks last year when the U.S. supply grew over 1 million barrels. This year, I'd be surprised if it grows over 300,000 or 400,000 barrels. So I think when you couple those two with rising demand, which it appears we're likely going to have, I would be surprised if we end the year anything less than the 90s.
Neil, the fact that we did see this extension, though, of the cuts, is that maybe a sign that demand isn't going to be where we initially thought it would be here through the second quarter?
It definitely, the great point. For the first half of this year, I think you're absolutely right. I think we were hoping we would come out a little bit hotter on the demand side. I mean, both for the macro economy and just the energy segment in general. But you're right, the ramp is starting. I can feel it even as I talk to my investors. The sentiment is improving. But right now, I can still tell you, coming in this weekend, the energy group was the most shorted group of the sectors out there. So sentiment is improving. It's just taking longer, to your point, than we expected.
Are we expecting this to, especially with the wave of consolidation that we've seen in the oil and gas sector over the last year, would you say that there's more to be expected at this juncture, or is much of the deal making behind us and now it's focusing on driving and pulling out some of these synergies that companies have really been focused on with those consolidation efforts?
I think it'll be active, not as active. We've seen some of the biggest deals in my time. I've done this a long time. But the continued need for inventory for a lot of companies, I could list 7 or 8 companies that I think are going to have to add inventory this year. So I think there's going to be some activity, just not to the size and not as many as we've seen. But again, certainly $80 plus prices, almost where we are now. You think about it, my best companies have a break even all in around $40. They're making a ton of money here at anything close to 80.
Neil, from the conversations that you're having with investors right now, what's the sentiment towards some of these energy stocks, and where are you seeing that opportunity, especially in the second half of the year?
It's been interesting. It's a good question. And the sentiment has been, I like your group, but what's the rush? Why do I need to own these now? And I think as you've seen now, the tech and other sectors start to pull back a little bit, I think you're going to start to see that switch. My sector pays out, I think, more than any other sector out there between the dividends and the shareholder returns. So if you look at a Diamondback Energy, FANG, who just did a large deal or announced a large deal and their stock went up because of it, or Permian Resources, both, PR, both very, pure Permian companies, they both pay out well. They both buy back shares. They both have been adding inventory. They're just doing the right thing. So again, I love the payout that this group has that I don't think any other sector could match.
Neil, just lastly, while we have you, I mean, in an election year, it certainly does come back to some of the larger climate goals, energy transition. Where is the oil and gas, the energy sector more broadly, where do you believe that could be pulled in once again to some of what's expected to be a very vitriolic type of general election?
That's a great description. It's going to be polarizing who wins between the the administrations of both between the Republicans and Democrats, whoever wins is going to have a much different agenda the minute they come in with energy. I mean, one, if it's on the Republican side, they're going to open all the pipelines. And, what's ironic about it, though, is if that happens, you could actually see prices go down. And on the other side, if they tighten on the Democrat side, you could see prices go up. So it's a bit opposite of what you would think. But to your point, it is going to be very polarizing. And I think as we keep getting closer and closer to November, that's something that investors are going to have to watch very close for the energy industry, because there's going to be big differences depending who wins.
Neil Dingman, always great to get your perspective. Thanks so much for hopping on with us here this morning on Yahoo Finance, Truist Securities Managing Director. Thanks, Neil. Coming up, RBC getting a bit more bullish on two names that maybe you should consider for your portfolio, Lyft and DoorDash. We've got more on that when we come back.
Lyft and DoorDash, they're both getting some bullish calls from RBC Capital this morning, with the analysts behind the call upgrading both stocks from sector perform to outperform, saying both companies could greatly benefit from a potential partnership. You're taking a look at shares of Lyft here this morning. They're feeling lifted by about 6% as of right now. There was a lot to really break down from this particular call here, but really trying to ship Lyft and Dash, ship for all those who don't have Urban Dictionary out there, when you're trying to basically put two of your friends together and hope that they come out in a successful relationship. At least that was my interpretation of it, but that's what the
actually I did not know that word.
I had to look it up a couple years ago.
Oh, there we go, ship, okay. Well, That's the perfect analogy to use, them, because this is more of a partnership. It's not exactly like they're saying it's going to be a buyout. That doesn't necessarily make sense, but it's more of a partnership here where both companies will be positioned, at least in the eyes of the analyst there, Brad Erickson, saying that both will be able to potentially benefit from this. He also mentioned when it comes to Lyft, and I think this is important to point out, that they have a driver supply analysis, and their analysis of that points to a more stable duopoly between Lyft and Uber. And I think that was a big question over the last several quarters, whether or not Lyft was going to be able to survive on its own, how viable of a competitor it was going to be to Uber in the long run, given Uber's dominance here of market share. But again, RBC more positive on the name on your screen, DoorDash more positive on Lyft, and also saying that, hey, a partnership between these two could make a heck of a lot of sense and could push gains for both here moving forward.
Yeah, if you're Grubhub and reading this note this morning, you're like, what do we chop liver? We got Grubhub, we got Seamless, but look, DoorDash crushing it right now with Caviar. That was a very strategic acquisition that they made years back. And so now thinking about how they can lean further into what could be a partnership at some point between Lyft and DoorDash, and ultimately for DoorDash, what that means and the expansion of existing users of a Lyft platform there, that could potentially extremely benefit DoorDash. They moved to outperform on Dash, raised their price target to $175 as well. 27 times the EBITDA for 2025 is what they're looking at here, and believing that new verticals plus international may be on the doorstep of stabilizing profitability for DoorDash here.
Yeah, certainly some bullish names out here, raising the price target on Lyft to 23 from 17. Certainly they see a lot of upside from current trading levels. All right, well, coming up, we're talking more about the AI boom, specifically Nvidia. That's up just about 75%. We've got an analyst coming on saying that there's more room to run for Nvidia, and there's more room to run for many of Nvidia's rivals. We've got that for you when we come back.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Welcome back, everyone. It is 10 a.m. here Eastern Time as we've kicked off the first full trading week of March here. We are, of course, Yahoo Finance Live. Brad Smith alongside Shauna Smith, 30 minutes into the trading day. Let's take a look at how things are shaping up. First and foremost, taking a look at some of, well, we'll get to these electric vehicle names here in a hot second here. But first, let's toggle you on over to the markets, the general markets, as we're taking a look at the Dow, the S&P 500, and the Nasdaq. Earlier this morning, we were taking a look at the open, and we were down pretty much across the board, just taking a little bit of a breather. All right, Dow Jones Industrial Average right now, though, down by about 0.2%. Nasdaq Composite lower by about 0.25%. S&P 500 down by about 0.1% here. But we got to take a look finally at some of those individual movers as well here.
All right, let's take a look at some of those individual movers. First up, we're taking a look at Ferrari hitting the brakes to a certain extent here this morning. Some pressure on the stock following Citi downgrading the name from neutral to sell. The analyst behind that call saying that after that 30% rally that we have seen since December, they see the current valuations as risk, so they are moving to the sidelines when it comes to Ferrari, again downgrading that name to sell.
And we're also taking a look at Dutch Bros here this morning. Dutch Bros shares moving higher after getting an upgrade that we've been tracking from Piper Sandler to overweight. The analyst behind the call actually is saying that we think that now is the right time for us to become more constructive on the coffee chain here. So good sip of positive news here for Dutch Bros out the gate this morning.
All right, well, let's talk about the big story for the markets over the last several months, really over the last several years, and that is Nvidia and the AI trade. The AI mania here really really driving the market action. You've got the Nasdaq coming off that record high. Nvidia shares up just about 75% so far this year. Our next guest saying that there's more room to run in the AI trade, and he's wildly bullish on semiconductors. Let's bring him in. We have Chris Danley. He's Citi's head of U.S. Semiconductor Research joining us now. And Chris, I think many investors are at home right now asking themselves whether or not we're starting to see a bubble form in the AI trade. What do you think?
Yeah, good question. So I hate admitting it, but I've been covering semis for 30 years. And I would say that the last time we saw a single application drive what we call TAM expansion in semis, it's actually expanding the semiconductor market, was about 25 years ago with the advent of the internet. And I think that's probably the closest thing to what AI has done. Now, the internet eventually led to a bubble as well, but that went on for a good 2 or 3 years. And, semis, I will never go out and say that they are no longer cyclical. So at some point, this party will end, probably in a lot of tears. But for right now, we can't really see the end of it. I think what's going on is that entities, whether it's a government, a university, a business, are buying AI product, whether it's Nvidia or AMD or Micron or Broadcom or what have you, and they've either bought just a little bit of semis before, or they really haven't bought them. And again, we haven't seen this. I hate using superlatives because we get a lot of superlatives thrown around in semis and they don't actually work, but we haven't seen anything like this in probably a quarter century.
Who were the first departures from the AI party if we do see a bubble burst?
That's a good question. So as we've seen, what goes up must come down. And I would say that, in covering semis for 3 decades, when you do have a downturn in any particular end market, witness the downturn we had last year. Now the stocks inflected the year before, but the downturn we had last year, it impacts everybody. So whenever the party ends, I really would not harbor any illusions about any of these stocks being able to get through it unscathed. But we really don't see any end in sight. So I think we've got a long way to go until we're going to start ringing the alarm bells, or even hearing a tinkling of bells out there in terms of AI.
And Chris, you put it quite simply in your notes, saying that you're widely bullish still on semiconductors. What's your top pick within that sector?
Top pick is Micron. So I think, we've all identified Nvidia as the clear AI leader. I guess in this sort of instantaneous market, they're almost yesterday's news in terms of AI. What we think is going to be the next group of semiconductors or product of semiconductors that's going to have the AI mentioning is going to be memory, and specifically DRAM. So clearly there's a lot of graphics chips going into it. Clearly there's a lot of Ethernet chips that Broadcom makes going into it. By the way, Broadcom announces on Thursday. We think that's the next positive catalyst for the AI market. But you're just starting to see memory come into play as, wow, we need more of this. This is in shortage, and Micron is the top pick on the DRAM space for us.
And then when you think about some of the language learning models that then give way to applications, who are the companies that have clearly got a handle on how they can develop those applications and then distribute them to the masses and making sure that they're monetizing from that aspect as well?
Yeah, that's a great question. And I'll give you an analogy is, NVIDIA has their GTC. It's sort of their, Woodstock, right, for AI. And they invite all kinds of people, companies, and markets to this thing. And I have friends that are in completely unconnected industries to tech, healthcare, for example, and they're going to this thing. And they're asking me, hey, how do we use AI? I've got a friend at company X or company Y, and they figured out how to use AI and increase their productivity already. And so we need to use that at our company. And this is one of the impetuses for the note last week is this, TAM expansion. So I think it's really NVIDIA that's driving it. I mean, they essentially control not just the processing, but also the ecosystem. And the only other time we've seen this in semis is Intel, 25, 30 years ago, when you had the advent of the internet and you needed a lot of servers and data centers. And Intel, along with the rest of the ecosystem, really set the stage for that. So that's why we think NVIDIA is going to get 90% of the AI processing market. It's really one of the better opportunities we've ever seen in semis.
Chris, I'm curious from your experience here, since you have been covering this space for 30 plus years, how do you compare the excitement and the mania surrounding AI to what we've seen play out in some of the past excitement events when we talk about the internet or the .com bubble? I mean, how does today compare to what we saw about 2 decades ago?
Yeah, and again, I'm probably one of the more skeptical analysts out there, likely because I've been doing it for so long, and every 3 or 4 years you see some new hot trend that flames out. And I would say that the reason that, I feel comfortable using that, biggest thing in 25 years in TAM expansion is the proof is in the pudding. So in the span of just a few years, you have had NVIDIA's data center division go from just a few billion or a handful of billion to 70 billion. You've had a market, the AI market. We weren't even talking about AI as a driver for semis even a couple of years ago. AI is probably going to be 10% of the entire semiconductor market this year, and semis are one of the biggest markets out there. It's 500 and something, 550, 580 billion this year, and the growth is continuing. So we think that eventually it can be 20, 30% of the semi market. Again, the proof is in the pudding. We've had a lot of fads that I would call them come through, and you don't see these kind of numbers being generated by the companies, and here we are. And again, we haven't seen upside. You had everybody from Nvidia kicked it off last year in April to Dell just blew away the numbers last week. Dell also talked about this TAM expansion where companies are just coming out of the woodwork and buying this stuff because of the increase in productivity that they're seeing. So it's really, I haven't seen it in 25 years. And again, I'm the last guy to use superlatives out there, but I have to call it like I see it.
And we appreciate you for doing that. All right, Chris Danley, always great to have you on Yahoo Finance. Look forward to having you back again soon. City Head of U.S. Semiconductor Research. Thanks so much, Chris.
Thank you.
All right, coming up, we're going to have more on Boeing. Boeing is in talks to buy back maker Spirit AeroSystems. This comes following a long list of defects here with its Boeing 737 MAX 9 jet. We've got more on that, what it means for the two companies next. Well, Boeing is in talks about a potential reacquisition of Spirit Aerosystems. It's a key supplier for the 737 MAX jet. Now, this potential deal comes as Boeing faces a lawsuit from passengers who were on the Alaska Airlines flight when a section of that Boeing 737 MAX 9 jet blew out shortly following a takeoff. We want to bring in Tony Bancroft. He's Gabelli Fund's Commercial Aerospace and Defense ETF portfolio manager here to join and talk to us a little bit more about what this would mean here for Boeing Spirit Aerosystems, excuse me there. Tony, let's talk about why this would make sense. Does this make sense for Boeing to potentially reacquire Spirit Aerosystems?
Yeah, thanks for having me back, Shauna. Yeah, I think it does make sense in the long term. I think near term, there's going to be no silver bullet. You're going to see some probably integration, hiccups and fits and starts as two large entities try to combine, like any large merger. But I think over the long term, before the pandemic, 80% of Spirit's sales were to Boeing. So it's essentially is an entity of Boeing, and obviously it was an entity of Boeing before 2004. And I think taking out some of the traveled work, the transport from Wichita to Renton of the fuselages, and streamlining the businesses, getting a culture together, and the synergies that you probably gain from those. It's going to be a long term. I think there's a lot of opportunities, to combine their operations and get some more efficiencies and more opportunities for the two companies. So I think in the long term, we're going to see this as to be a good thing for Boeing.
Does this ultimately remediate some of the quality assurance issues that have come to light and that investors still have questions about within the broader manufacturing process here? Yeah,
that's a good point, Brett. I think the impetus for this probably was, for all intents and purposes, was the recent incident. What they released from the initial NTSB report was that there was some rework going on from the Spirit plant at the Boeing facility, and I think there's probably a thought process, and I think the FAA Administrator Whitaker probably alluded to that in sort of behind the scene talks with Boeing, that you sort of own the jet from soup to nuts, and I think Boeing probably took that to heart, and it just makes sense. Imagine if GM were to have a third party build its chassis versus in Flint, Michigan, or essentially any other company, large manufacturing company. I think it's just a natural way to do business, to own such a large part of your manufacturing process.
Tony, Boeing is your third top holding, I believe, in your aerospace and defense ETF. Have you, following what has taken place over the last several weeks, have you at all shifted your outlook or your strategy when it comes to investing in Boeing?
Oh yeah, so Boeing is a large holding, as is actually Spirit in our Gabelli Commercial Aerospace and Defense GCAD ticker ETF, our actively managed ETF. We think this is long term. This is going to be a positive for Boeing. Nothing's changed as far as strategy. There's still a lot of backlog that Boeing has. Over 5,000 plane backlog, and over the next 20 years, Boeing and Airbus are going to probably make over 40,000 plus planes. So I think there's unconstrained demand, all the secular tailwinds of the emerging middle class with disposable income, wanting to travel more, see the world, sort of the experiential generation and economy. I think Boeing is right at the center of it to benefit from that.
At what point is Boeing paying too much for Spirit Aerosystems from your purview here? I mean, this is a company that they sold back in 2004, 2005 for $900 million. Now it's got a market cap of just under $4 billion. At what point is the price tag too much?
Yeah, I mean, we carry Spirit at around, maybe this year, a $45 private market value. Could be anywhere, just depending on production rates and timelines. It could be anywhere easily in the 50s. at relatively conservative multiples with inside of industry multiples for a large scale manufacturer, just for the growth of the backlog. I mean, there's just a lot of operating leverage as these rates start to increase.
Tony, do you see this deal facing any sort of regulatory pushback?
Yeah, I don't think this. I think it's probably the other way around. I think that again, FAA Administrator Whitaker is sort of tipping his hat, saying that, you know, Boeing, you own this system, and I just have a hard time seeing the FTC or whomever coming in saying that you know, there's a regulatory problem, especially since they previously owned them, and Boeing is essentially, you know, they're going to have to spin off the plant in the Airbus plant in Belfast, Ireland, and in North Carolina. And, you know, it's a relatively small portion of the company, and I don't think there'll be any issue. And it sounds like Airbus, from what they've alluded to, that they have no issue with it as well. I think in the long run, this is, you know, it's essentially it's one customer, so I don't see that likely as an issue.
Tony, thanks so much for taking the time here today. Tony Bancroft, who is the Gabelli Commercial Aerospace and Defense ETF Portfolio Manager. Appreciate the time.
Great, thanks for having me.
Certainly. Let's switch gears here for a hot second. The Supreme Court ruling in favor of former President Donald Trump, putting him back on the Colorado ballot. Here with more, we've got Yahoo Finance's Rick Newman with the details. Hey, Rick.
Hey, guys. So this is one barrier Trump will not face this year. The Supreme Court said Colorado cannot bar him from the ballot. There are two other states that have done this, Maine and Illinois. So that means those two states won't be able to do it. So Trump goes forward. I think the important thing here, Trump is not likely to win he's not going to lose a general election. He's not going to win Colorado, and he's not going to win Illinois. There is one electoral vote in Maine that he could get. But I think this obviously will prevent other states from trying to do this, such as possibly Pennsylvania or some swing state. So this is now a non-issue for the 2024 campaign. And I think it's important to point out this was a unanimous ruling by the Supreme Court. So there's a 6-3 conservative majority on the court, but even the 3 liberal justices said, no, this doesn't seem like something a state can do. So Trump has plenty of other problems, legal ones, funding problems and other things, but this is not going to be one of them. He's going to be on the ballot in all the states.
Rick, you mentioned the two other states, Maine and Illinois, followed suit here with Colorado. Where does that stand? I guess specifically Maine. Do we have any idea about the timeline potentially of that decision?
Well, this was all relating to the primary elections. But it carried implications for the general election as well. So Trump is cruising to victory in the primary elections. He may clinch it after the Super Tuesday states vote tomorrow. I think this just wipes this away completely as an issue. Trump will be on the primary election ballots in those states, and he will be on the general election ballots in those states. So this one is over.
All right, Rick, thanks so much for breaking this down, tracking this, and of course, all of the implications. And we're going to watch some of the other cases as they play out too. Rick, appreciate it.
Hi, guys.
Thanks. Well, coming up, Bitcoin topping 65,000, everyone, putting it within striking distance of an all-time high. We're going to break down the supply and demand balance in the crypto space ahead of Bitcoin's halving and the quadrennial halving, we should note here. The price of Bitcoin has no shortage of catalysts, from the debate around regulation to whether it's a security or a commodity, and whether or not it really is digital gold. But one event is undeniable in its impact on the world's most premier digital asset, the halving. Every 4 years, the reward for mining the biggest cryptocurrency is cut in half. This happens in order to reduce the amount of coins in circulation. How is it calculated? Well, it happens specifically every time 210,000 blocks are mined. We can calculate the date fairly precisely with the knowledge that the average block time for Bitcoin mining is around 10 minutes. That calculation gets us very close to 4 years. Why is it needed? Because there's only so much Bitcoin available, 21 million to be exact. And like any other cryptocurrency, it needs to remain scarce to hold its value. So how often does this happen? Well, the halving takes place every 4 years. The first in 2012 decreased the award for creating a new block from 50 to 25 Bitcoin. The second halving in 2016, that lowered the reward further, from from 25 Bitcoin to 12.5 Bitcoin. Last time out, 2020. And you guessed it, we have it again. The block award dropping to 6.25 Bitcoin. So there's nothing wrong with your math here. This time around, the block reward miners will receive half, 3.125 Bitcoin. The big question, of course, what happens to the price? Now, the moves could be significant. In the past, we've seen Bitcoin rise after a halving event, though there's no certainty that this will always be the outcome. The other key focus is the outcome for the miners. The rewards that they're generating will, of course, diminish, and that's not great for an industry with a very high cost burden. Keep an eye on how the big publicly listed miners, the likes of Marathon and Riot, manage this event. As ever, talks of consolidation will no doubt do the rounds. No matter how you look at it, the event will have serious consequences for all crypto stakeholders and will be across all of the developments here at Yahoo Finance. Bitcoin inching closer to all-time highs as the crypto market certainly reaps the benefits from the addition of spot Bitcoin ETFs here, plus more applications for Ethereum ETFs. All of this is positive for the broader crypto space. Here to discuss what's next for these digital assets, we've got Matt Hogan, who is the Bitwise Asset Management Chief Investment Officer here. Matt, great to see you. What from your stance is the biggest catalyst that is continuing to move crypto higher and Bitcoin specifically after we were anticipating more largely a sell the news type of event once the Bitcoin ETFs finally went public?
That's right. But I think the demand for these ETFs far exceeded anyone's expectations. By any measure, these are the most successful ETF launches of all time. And as you mentioned in the last segment, sometimes it comes down to simple supply and demand. If we looked last week, these Bitcoin ETFs purchased over 30,000 Bitcoin net, and Bitcoin miners only produced 6,000 Bitcoin. And as you said, that number is going to fall in half the amount miners are producing in a few weeks. More demand, reduced new supply. Sometimes it's as easy as that to explain why the price is going up.
Yeah, Matt, when you have Bitcoin right above 66,000 coming off its best month that we have seen since 2020, is there anything, do you think, standing in the way of this massive rally that we're seeing?
Yeah, the thing that could stop Bitcoin from rallying is if long-term Bitcoin investors decide to sell, right? Because the ETF is soaking up more than 100% of the net new supply. So it's only when people who have been holding Bitcoin for 6 months, a year, 2 years, 3 years decide to sell that we could see prices pull back, because I don't see the ETF demand going anywhere. You could see some of that selling as we breach new all-time highs, but I think we're going significantly higher. I think this is a bull market with legs. I think we'll still be talking to this about this into the summer and beyond.
Matt, I'm not sure I entirely realize just how many people are heading to the ballot boxes this year internationally. You've got 64 countries holding elections here, and what's anticipated to be a record year for the number of people voting. Here's why I bring that up. That also means that in some areas in the world, crypto might be on the ballot as well. Are there large elections that those who are holding Bitcoin and other cryptocurrency assets should be paying closest attention to?
Absolutely. This is actually a big catalyst for crypto this year. Yes, the ETFs are important. Yes, mining is important. Potential Fed rate cuts are important. But the election could be a huge catalyst. If you look just here in the US, about 100 million Americans have some exposure to crypto, according to statistics. Even if 5% of them incorporate crypto into how they vote, that could tilt the elections. And you're already seeing politicians start to play to this. You're seeing momentum for crypto in Washington. 2022, early 2023, crypto faced huge regulatory headwinds. I think those are going to flip to tailwinds as we enter the end of this year. And it's part of the mainstreaming of crypto, which is, the sort of meta narrative for this bull market.
Matt, when it comes to Biden versus Trump, it looks like that's going to be the likely matchup here in 2024. Is one better than the other for crypto?
Look, crypto wins as long as there's not a complete Democratic sweep of both houses of Congress and the presidency. Again, the tide is rising for crypto across the board. I think either would be fine. Maybe on the edges, much of crypto would prefer a Trump victory, less sort of harsh regulation from the top down at the SEC. But again, unless there is a complete Democratic sweep, I think it's positive for crypto. I think generally the Washington trends are moving in crypto's direction.
I want to talk about something that you mentioned as well here, Matt, which is a new era of price discovery for Bitcoin. Break down that thesis for us a little bit more.
That's right. If you think about the first 15 years of Bitcoin went from zero to about $40,000, mostly on the backs of self-directed retail investors. Most financial advisors, family offices, institutions couldn't buy Bitcoin because they can't invest through an app. But once we got an ETF, that's unlocking those markets. And those are huge markets. Globally, that's $100 trillion market. If they allocate 1%, 2%, or 3% of their portfolio to crypto, which we think would be appropriate, it's a complete game changer for this industry. It's like when stocks go public. It goes from a few investors owning it to a lot of investors. Sometimes the price goes down, but often the price goes up substantially. What we're seeing here is this massive source of new demand meeting a fixed supply, and the price has gone up significantly. We're up 157% over the last 12 months.
Matt, talk to us. We've certainly seen a heck of a lot of interest in the spot Bitcoin ETFs, but Grayscale has seen a tremendous amount of outflows overall since the approval of spot Bitcoin ETFs. We have not seen that sway traders' approach or really risk sentiment surrounding Bitcoin. Talk to us why exactly that is and whether or not you see that at all potentially changing here in the future.
Yeah, sure. Grayscale converted their private trust to an ETF on the same day that the other ETFs launched. And they brought $26 billion in net assets to that conversion. But their fund is priced much higher than competing ETFs. GBTC is a 1.5% expense ratio. The Bitwise Bitcoin ETF, BITB, is just 20 basis points. So that's a massive difference. Not surprisingly, you're seeing assets flow out of GBTC into lower cost competitors, but the lower cost competitors are eating up all of GBTC's outflows and then some, right? They've added, I think, $7.5 billion of net new flows. As long as the new ETFs are hungrier than the GBTC outflows, we're going to continue to see, positive support for prices.
What's your end of the year Bitcoin call if you guys maintain one right now?
In December, we published our 2024 predictions. At the time, Bitcoin was $40,000. We thought it would go to $80,000, a new all-time high. But based on what we're seeing in these new ETFs, I think that has to be revised upwards. $100,000, maybe $150,000, maybe more. We're working on that revision right now. We're fine-tuning the models, but it's going to be 6-digit Bitcoin. And I think there are very few things that could hold that back. It's just a perfect setup for this asset class.
That's the headline right there. Matt, thanks so much for taking the time here. Matt Hogan, who is the Bitwise Asset Management Chief Investment Officer. 6-digit Bitcoin revision coming from your team. We'll be waiting for that. Thanks so much.
Thanks for having me.
Appreciate it. Everyone, coming up, Federal Reserve Chair Jerome Powell is going to testify on the state of the economy on Wednesday. What this means for the market after the break.
Well, markets are lower this morning with investors cautiously looking toward Federal Reserve Chair Jay Powell's testimony this Wednesday and Thursday. We've also got the jobs print on Friday. Investors are divided with some of that data, some predicting rate cuts in the second half of the year. In terms of consensus, though, traders expecting 3 cuts before the end of the year. So let's bring in our next guest. We have Gus Fauché. He is a PNC Financial Services Group chief economist. Gus, it's good to have you here. So I think a lot of people are questioning what we're going to hear from Powell, whether or not it's really going to move the needle in terms of the market's expectations for rate cuts before year end. What are you expecting to hear, and what are your expectations for those rate cuts?
I would expect that Chair Powell will say that he does expect to see cuts in the Fed funds rate sometime later this year, that they're not going to happen at the March meeting, that the Fed is seeing progress on inflation, wants to see a little more progress on inflation before they start to cut the Fed funds rate. But I think overall the view is that we will see rate cuts, a handful of cuts sometime later this year, but not imminently.
Yeah, and not even half a dozen, which was some of the guesstimations coming into the start of this year, as educated as they were. What, from your stance, what is the real number that we should be anticipating?
You know, I would expect that we'll start to see rate cuts in the second quarter. I think that inflation is slowing. I think that the strong January numbers are a one-off, and we'll see slower inflation in February and March. And then I think we see 3 or 4 25 basis point rate cuts over the course of 2024. So definitely an easing in monetary policy. Monetary policy at that point would still be contractionary. It would be weighing on economic growth, but less so than it was at the end of 2023 or at the beginning of 2024.
Because we know the street obviously very divided on what those rate cuts are going to look like. Torsten Slok at the end of last week saying he actually doesn't see rate cuts before the end of the year. I'm curious to ask you, if we do, I know it's not your base case, but if we don't see rate cuts before the end of the year, what happens then to the economy?
I think that increases the risk of recession. I think if we don't see rate cuts this year, that means that inflation remains high and the labor market remains strong, which is obviously good news in the short run for economic growth, that strong labor market. But I think if we see monetary policy remaining very contractionary, then that does increase the potential for recession, not this year, but in 2025 or 2026. That isn't my base case. I think that monetary policy will be relaxed somewhat, and that will support continued growth over the next couple of years. But if we're in a situation where that Fed funds rate is still around 5.5% at the end of 2024, then I think recession risks move back higher.
And then what we've continued to also hear is that there is a concern that we could see another spike in inflation, and that really being on the back of the resilient consumer that we've continued to track as well here. And if we did see interest rates get cut, that's just more lighter fluid for the consumer to be more confident, it seems like. And so where are the areas where inflation would still remain sticky, where consumers would have to expect that there would still be elevated prices?
So I don't think goods are a particular problem. We continue to see supply chains are in much better shape than they were a few years ago. We continue to see goods demand has basically been flat since 2021 with higher interest rates and all of the buying that we did coming out of the pandemic. I'm more concerned about services inflation, in particular housing inflation. The way housing costs, the owner's equivalent rent measure for home ownership is calculated in the PCE price index. That remains elevated. We're seeing a divergence between the cost of home ownership versus the cost of rent. And, if that continues, if the cost of home ownership continues to increase at a pretty rapid pace, then that could cause the Fed to hold off on rate cuts. And that, again, could be a problem for the economy, not this year, but next year.
Because what about the rise that we're seeing in the price of energy, crude moving to the upside? We have OPEC Plus extending those cuts. Do you see that potentially complicating the Fed's fight against inflation?
I'm less worried about that for a couple of reasons. First of which is that the Fed is more focused on core inflation excluding food and energy. Second reason is that the Biden administration has a very strong incentive to get energy prices down ahead of the election. So they will do what they can to increase energy supply and bring energy prices down. And then typically in the United States, when we see high oil prices, we see a strong response in supply. We see more drilling activity. I don't see why that wouldn't be the case this time around. And that should help bring down energy prices over the next few months if we do see a sustained increase in the near term.
Gus, what happens if we get another red hot jobs report this week?
I think then that does complicate the picture for the Fed. They are looking for a slowing in job growth. They are looking for a slowing in wage growth. If we continue to see job growth running above 200,000 per month, if we continue to see an unemployment rate that is noticeably below 4%, if we continue to see average hourly earnings that are increasing 0.4%, 0.5% per month, not slowing on a year-over-year basis, then I think the Fed does need to be worried that the labor market is still too tight. And that could mean that the Fed doesn't cut until sometime later in 2024, or even worse for the economy, the Fed feels the need to raise rates because they want to cool off the labor market, and the labor market just isn't responding to the rate cuts the rate increases that we've already seen over the past few years.
PNC Financial Services Group Chief Economist Gus Fauché, thanks so much for taking the time.
Thank you.
Appreciate it. Well, everyone, switching gears here, housing hurdles aren't going away anytime soon. We were just having part of that conversation. Home buyers grappling with a low supply that is pushed up prices here, making buying a home unaffordable for many Americans. Here are 3 things that you need to know about the 2024 housing market right now.
The U.S. housing market is facing a trifecta of challenges when it comes to affordability: tight inventory, climbing prices, and elevated mortgage rates. So what does this mean for buyers and sellers? Here are 3 things you need to know about the 2024 housing market. Number 1, inventory. People are staying in their homes longer. Thank you, baby boomers. The lack of homes for sale and high housing costs are just some of the reasons people aren't moving. Sales of previously owned homes hit its worst level in decades last year, as elevated rates and rising home prices deadlocked affordability. The demand-supply imbalance will carry into this year. There is a 3.2-month supply of unsold inventory at the current sales pace. For perspective, at least 6 months of inventory is considered a healthy market. Despite the tight inventory in the resale market, the newly built home market remains attractive. New homes accounted for nearly 32% of single-family homes for sale, Redfin reported, marking the highest level of any fourth quarter on record. But inventory is only part of the story. There's also the dilemma with home prices. Number 2, home prices. Buyers beware, but sellers rejoice because home prices have never been higher. The median price for a home is around $361,000, up 5% from the prior year, Redfin reported. The pressure of limited housing supply has kept home prices elevated. Homes were 6.7% less affordable in December on a year-over-year basis, the National Association of Realtors reported. Despite elevated prices, builders were able to take advantage of lean inventories in the resale market and offer buyers incentives, including price cuts. The median sales price of a new home fell 6% from a year ago to $434,000. But it looks like home prices won't be leveling off anytime soon. Data from Wells Fargo projects new home prices to rise 2.2%, while existing homes are estimated to increase 3.1% this year. Number 3, mortgage rates. Another reason for the limited supply of homes has been the lock-in effect. At least 80% of homeowners who hold a mortgage had a rate of 5% or lower nationally in the third quarter of 2023, discouraging homeowners from selling and buying another in today's high interest rate environment. Rates have roughly doubled since the pandemic, thanks in part to the Federal Reserve's fight against inflation. Inflation remains stubborn, leaving rates elevated. Last year, mortgage rates rose above 8% in October, but have now come back down to range around 6%. Data from Freddie Mac shows that the average mortgage rate for a 30-year fixed loan climbed to 6.7% from 6.64% a week prior. Not much reprieve there. By contrast, home builders have been able to win the housing recovery by giving buyers what they want: mortgage rate buydowns. That's when the builder upfronts the cost to lower the rate on the loan, making new construction the place for deals in this housing market. Economists expect the housing recovery to stall over the next few months, given that long-term interest rates have jumped back up again this year. However, the hiatus will likely be short-lived. How will this economic picture play out throughout the rest of 2024? Make sure to stay up to date on the latest developments as Yahoo Finance continues breaking down everything you need to know about the housing market this year.
It's a busy week in the world of politics, and there's certainly a lot at stake for American Super Tuesday. Kicks off this week, where millions of voters across 15 states and one U.S. territory gearing up to cast their ballots in the 2024 presidential primaries and caucuses. President Joe Biden is also set to deliver his annual State of the Union address. That's Thursday, just 2 days after Super Tuesday. For more on what we can expect this week, we're joined by Jeanette Lowe, who is the Strategic Managing Director of Policy Research. Great to have you here with us this morning. So first and foremost, as you think out to Super Tuesday and how that sets up for voters, what are we going to look to understand more clearly here from Super Tuesday and kind of apply that to what's yet to come later on this year in November?
So I think, first of all, thanks for having me. And so with Super Tuesday, one of the things that we're really looking for here is, we do expect Trump to do very well in all of the states that are having primaries on Tuesday. The one place that we might be looking to see if there might be some differences would be a state like Virginia. So Nikki Haley is still staying in this primary race. She won her first primary over the weekend with the District of Columbia, but she is very far behind in the delegate count, and she should be after Super Tuesday as well. But she's still looking at this dynamic of saying, in certain states, there are 40% of the voters who are still voting for her. She'll be looking at a state like Virginia, where recent polling had her down just by 8 points against former President Trump. So she might be looking to actually stay in this race longer than Super Tuesday, which could create an interesting dynamic. The longer she stays in, she continues to attack the former president. That could hurt his campaign going into the general election. And that's also something that we've been watching quite closely, because Trump is actually having some of the best polling that he's had since he started his political career. And we have the general election kind of seemingly already decided with Trump and Biden. But the longer Haley stays in this race, I think, is kind of important in trying to determine what happens going down the stretch, because obviously polling is quite early and we can't make any real assumptions just yet on what will happen in November.
Yeah, Jeanette, digging into that a little bit earlier, talking about Nikki Haley's strategy and her influence at this point within the election process. I guess have investors priced that in, and what does that mean just in terms of the ultimate impact that it could have on investment portfolios the longer that she stays in the race?
Yeah, so we have built election portfolios for if the Democrats have a sweep in the election and if Republicans have a sweep in the election. And what we've been finding right now is the way that those portfolios are trading, you see investors basically giving a 50-50 chance to whether Biden will win or whether Trump will win. And we think one of the reasons is that this is just not a normal election cycle. The former president has a number of cases that he still has to contend with ahead of the November elections. We had the Supreme Court last week decide that it's going to do oral arguments in April to decide whether or not he has presidential immunity. Then that will have a ripple effect as to whether or not his January 6th trial will take place before the election. And these things are all important. It's difficult for investors to price in which candidate will ultimately win because of them. And it also creates this interesting dynamic with Nikki Haley still in the race. Could she be waiting to see if there might be a path forward for her if there is an issue with either a legal case for Trump, if there's a health issue with Trump, things of that nature? It creates a lot more of different scenarios that I think investors have to think about. And so it's a little hard for them to be able to price the election in this early.
Okay, so big week on the election front and what we can learn from that. Also big week in Congress, working to pass the first 6 fiscal year 24 appropriations bills, and then, of course, hoping that we don't have to kick the can down the road further with regard to the other 6 that are set to come. How can that also impact portfolio strategy?
Yeah, so this is important. I think something that doesn't get a lot of attention. So Congress avoided a shutdown last Friday. They made an agreement to pass 6 of the first appropriations bills this week. These are the easier to lift bills. So we still have the heavier ones to go, the next 6, which includes things like defense and Department of Homeland Security funding. Those need to be done by March 22nd. If Congress does not pass all 12 appropriations bills by April 30th, we're actually going to have a sequester go into effect. So there's going to be a 1% across the board cut to discretionary spending going into effect on April 30th if we don't have all these bills done. That's really impactful for defense stocks. They are currently expected to see a 3.3% increase over last year's fiscal year numbers if the current spending trajectory goes forward. But if this sequester goes into effect, they'd actually see a 1% decrease from their FY23 levels. So that's going to be quite impactful. And this also goes into the fact that we could see a little bit additional fiscal stimulus coming from higher spending levels from the higher spending bills over FY23. And so that's something else that we think is really important that investors probably haven't been paying as much attention to.
All right, Jeanette, always great to have you. Thanks so much for hopping on with us here this morning. Jeanette Lowe, Strategas Managing Director of Policy Research. Thanks.
Thank you.
All right, just about 90 minutes into the trading day, let's take a look at where things stand right now. Still pressure across the board. You've got the Dow off just over 100 points, flipping over to the S&P. That's still above 5,100, but moving lower by just about 0.1%. The Nasdaq, which has really been leading the charge. We talked about the rally that we've seen in a lot of those larger cap tech names. That is actually trading to the downside today, giving back some of those recent gains, off just about 0.2%. You could also see this broken down further into the sector action, some of the pressure that we've been seeing there with communication services, consumer discretionary, and energy among the biggest laggards in today's moves.
Yeah, I heard you like heat maps, so we've got a few of them pulled up here on your screen to end the show as we close out this first 90 minutes of trading. Take a look at the Nasdaq. As you were mentioning, those tech-heavy names here, we're taking a look at some of those mega-cap tech stocks as well here today. Not much movement if you're Microsoft or Amazon, which is up by about, we'll call it 0.9% right now. But take a look at Apple. Apple down 2.6%. We were breaking that down earlier with the EU fine. And then Nvidia, we were discussing that at length to begin today's show. We'll continue to watch that as we move on throughout the rest of today's trading week. And semiconductors in focus with Broadcom reporting this week as well here. That does it for us. You've got much more Yahoo Finance Live coming your way at the start of the 11 a.m. hour.
Welcome to Yahoo Finance Live. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita, and here's what I'm watching this hour. The record-setting rally for markets being put to the test this week. Investors looking ahead to Fed Chair Jerome Powell's testimony and the monthly jobs report. We're going to break down the potential dose of reality traders could face. Crypto riding a high as Bitcoin inches towards record levels. Spot Bitcoin ETFs playing its part in driving gains for the crypto space. Is this only the beginning? We'll discuss. And a win for the box office. Dune Part 2 delivering the best opening weekend of the year. We're going to speak with IMAX CEO Richard Gelfond later this hour on what's ahead for the entertainment tech company. That is coming up later in the show. First, though, let's take a look at where markets are trading right now. We are seeing all three major indices right now in the red. The Dow down about 95 points. The Nasdaq down roughly 24, and the S&P 500 trading pretty flat right now. Last week was a record-breaking week for the S&P 500 and Nasdaq. How long can this rally last? That's the question on a lot of investors' minds. Let's bring in our very own Jared Blickery, who could have the answer for us. Jared.
Oh, I thank you for the vote of confidence here. I will do my best. Let's take a look at where we are today. As you said, Akiko, the majors in the red, but the Russell 2000, which is trying to break to the upside to the highest level in years, trying to, I should add, that's up 1/3%, but it hasn't definitively broken out just yet. What we are tracking is a materials sector. That is the number one performer of the day, followed by utilities, then industrials, then tech, then financials. Those round out the outperformers as well as those in the green. To the downside, communication services is the worst off, down over 1%, then energy, then consumer discretionary. And let's just peek into the Nasdaq 100 here. It is not the best day for the Mag 7. There are some winners here. You got Amazon up 1%, Broadcom, which is now ahead of Tesla. Is that a mega cap? That's a question for the ages. Up over 2%, but it's Alphabet and Apple, which have really broken down here. I believe it's Alphabet here, Google, which is down to one of its key moving averages, but you can see it has fallen from this high, still holding on to gains, very respectable gains of 41% this year. But Apple just has been just kind of a disappointment this year. Here's a one-year chart, been really trading sideways through most of this, and we just broke the 180 level. We closed below it last Friday, and now we are trading well under it today, so probably going to head down to this support level, and we'll have to see what happens there. Also, I mentioned Tesla. Tesla is now down 6%. So that stock, which is now roughly down 3.5% over the last year, that has been trading a little bit sideways, but now in the bottom end of its multi-week range there. And let's just take a look at some of our leaders. Bitcoin, one of the stories of the day. We got to take a look at Bitcoin real quickly here because that is quickly approaching its record high, which is around 69,000. Depends on what exchange you're looking at, but if it hits 70, going to be across the board record highs, and that's going to generate a lot more enthusiasm that we're looking for, and also ahead of that big halving that takes place in April. We'll have to see if that is as bullish as it has been in the past for Bitcoin.
Okay, we're going to be talking a lot more about those Bitcoin moves later in the show. Thanks so much for that, Jared. Well, markets edging lower this morning, coming after the S&P 500 and the Nasdaq hitting record highs last week. We've got a busy week of political and economic news ahead, which might pose some headwinds for the markets. For more on what might trigger some of that volatility in the market, let's bring in Dave Mazza, Roundhill Investments Chief Strategy Officer. Dave, good to talk to you today. So we've got Super Tuesday on tap tomorrow. You've got Fed Chair Jerome Powell testifying before Congress. And then, of course, all of it leading to that all-important jobs report on Friday. What is the potential, you think, to move the most?
Well, it's interesting. We're coming on the heels of basically the end of earnings season. And earnings season actually was, I think, more robust than folks were expecting and stronger than many were anticipating, particularly with those Magnificent Seven and the mega cap stocks generating 15% year-over-year sales growth. We know a lot of that's coming from the really unprecedented numbers that Nvidia has put up there. But looking ahead, it's going to be a bit more challenging this week because it's with a dearth of corporate earnings. Now investors go right back to focusing on the Fed. Are we going to get a rate cut sooner than later? I think it's challenging because if folks are anticipating a rate cut in March. I think that's off the table, right? And then if we think about even May or June, how many are we going to get before the election? Because you're right, Super Tuesday's here. Nikki Haley with some interesting comments over the weekend about potentially not supporting Trump. Of course, that could just be grandstanding here. But I do think geopolitical risks are going to be increasing from investor attention now that we know the earnings recession is over.
If it is really all about the Fed this week, though, Dave, I mean, what specifically are you going to be looking for? The Fed chair has made it pretty clear that they're not comfortable moving forward with the rate cut just yet. Patience is the thing that he's talked about before. Given where expectations have come down, what more is likely to move the markets based on what we hear from him on Wednesday and Thursday?
Yeah, well, I think as Chair Powell has been trying to do, he's trying to be more measured and get investors to stay focused on the reality of the data. And the reality of the data is that the economy is okay. I think it's hard to say that it's strong. Some may characterize it as such. But really the most important thing has been and will be inflation. Of course, you noted big jobs report on Friday. Not that folks shouldn't pay attention to that, but really I think the main driver has been the path of inflation. And we know that it probably hasn't come down as quick as they'd like to see. There's some structural issues perhaps that are playing a role here. But for the most part, it's improved. So that, I think, is a reason that's underpinned this incredible market rally. Whereas noted, there are indexes across the board and markets across the board hitting all-time highs, throw in gold hitting an all-time high, Bitcoin hitting close to all-time highs, or at least over 60,000 on the path potentially to 70,000. Is that there's a lot of firepower in the market. So I think regardless of what Chair Powell says, I do think investors are going to probably absorb this week, maybe take up a bit of a breather. But for the time being, the momentum remains behind market moving higher.
Let's talk strategy then, Dave. You mentioned the Mag 7 obviously had an incredible run-up so far this year. Is now the time to maybe look outside of that space? Basically, if you're not in on it now, you kind of miss the boat.
Yeah, no, it's hard, I think, for any investor to say, hey, if I have new cash to put to work, do I start buying stocks at all-time highs? Of course, if you're investing for the long run, many probably shouldn't pay as much attention to exactly when they're getting in, but it's a lot easier to do it at lower and depressed multiples. But if we look at valuations, the Magnificent Seven from our work, and others have come out with somewhat similar data, aren't actually anywhere near a bubble territory. There's been a lot of attention paid on that just because of the strong moves that we've seen higher. Valuations are not cheap, but 29 times forward earnings for the Magnificent Seven, a little under 20 for the 493. So not necessarily cheap by historical standards, but the difference this time around, even from a few years ago, is that earnings and revenue has been there and is actually expected to continue to recover. If that changes, or increase, I should say, if that changes, it would change our sentiment on the market. So at least through the first half of the year, at least till we get closer to the election, we remain constructive on markets, even if they're trading at richer multiples, because the earnings and revenue has been there. Particularly for the mega cap companies, we are less constructive for the time being on small caps because they're in an earnings recession. They remain in an earnings decline. It's difficult for non-profitable companies, of which many are found in small cap indices, to do well in this macro environment. But it's really still an all clear signal for the Magnificent Seven until we see a real change in macroeconomic data, both positively or negatively.
So what's the number one sector you think investors are overlooking right now?
Well, it's interesting. The sectors that we think outside of the Magnificent Seven that are, again, are where there's some momentum has been and where investors probably could still see some further gains, even if they're a bit harder to come by, is areas like AI broadly, particularly generative AI. We are just scratching the surface of the potential that that can bring to productivity for enterprises, companies, and consumers. Then also the weight loss drugs, that's another opportunity outside of tech. We know that they've moved significantly higher, but there does seem to be some constructive news and further developments happening there. The sectors that I think everyone wants to get contrarian on and step into, like a financials or perhaps even an energy, which was a leader a few years ago, are just more challenged here. And a lot of it has to do with the fact that we do not necessarily see a change, a big change that I should say, in what the macroeconomic news is, both for jobs and for inflation.
Okay, going to be a busy week for you as well. Dave Mazza, Roundhill Investments Chief Strategy Officer. Good to talk to you today. Appreciate the time.
Thank you.
Well, coming up on the other side, Bitcoin topping $66,000 within reach of that record high that we saw in 2021. We're going to break down the supply and demand balance in the crypto space ahead of Bitcoin's quadrennial halving. We'll explain what that is after the break. Bitcoin continuing its rise. The price of the crypto asset pushing past $66,000 this morning, the leading digital currency within range of fresh all-time highs. Joining me now to discuss what's next for the crypto market, we've got Ian Rogers, Ledger Chief Experience Officer. Ian, good to talk to you today. What do you attribute the latest surge in Bitcoin prices to?
Thank you for having me. What a moment to be here talking about this when we're 5% off of all-time high, and we've just passed the all-time high on market capitalization for Bitcoin. I mean, in some ways, this is inevitable as predicted. As we approach the halving, there's every 4 years there's a run up, but you also have these ETFs which have recently been approved, and a lot of inflows coming from that. And what's it attributed to? I think simple supply and demand. I mean, you have a programmatically scarce asset, and people are 15 years after its inception, people are feeling comfortable owning it, and more people want to own it than are willing to sell it. Therefore, the price is going up.
We'll talk about the halving in just a bit, but when you think about where Bitcoin ETFs have gone, I mean, as you said, it was always expected to give a big bump, at least to the largest crypto asset, which is Bitcoin. What has that meant for Ledger specifically?
Well, for Ledger, it's when the number goes up, the sales at Ledger also go up. We move we move with the market, and I think the ETFs have provided a bit of an entry point for people, right? The educated people become Ledger customers, so it's great that people have this easy on ramp to Bitcoin, which causes them to to get more educated and ultimately find their way to self custody.
You talk about the on-ramp that's provided. I mean, is it really just about Bitcoin? Are you finding this broadening out beyond sort of the usual Bitcoin and Ether? I mean, what are you seeing in the crypto space overall?
I mean, the space overall, I mean, you have these, meme coins, across the board are, they're pumping even crazier than Bitcoin in many cases. They're coming from kind of, zero to something massive. I think whenever you get a run up in Bitcoin, you get other activity around the entire ecosystem. There's, rumors of an Ethereum ETF or hope of an Ethereum ETF. And I think, that's excitement and causing a lot of movement there, but it's, really across the entire ecosystem. I mean, even on Bitcoin, you have ordinals, which are Bitcoin NFTs with some very big sales. You had a very big CryptoPunk sale today. I mean, the entire ecosystem is explosive. I think, what you have is we had a big washout cycle where people saw what happened with FTX. There were other risks in the ecosystem, such as the settlement with Binance, which when these risks get cleared out, people get confidence and they want to buy back in. So I think the ETFs are just providing a way for more people to get in easily, and literally anyone in America can now very easily hold an asset which used to be only for the more technical minded. So I think it's just coming down the curve in terms of simplicity.
And on that point, Ian, I mean, we've heard a number of analysts who've come on to say, this rally feels a little different because of that very point you made. Some of the bad actors have been removed from the space. Is this rally on more the foundational footing, you think it is a little stronger than what we saw, for example, in 2021 when that record was set for Bitcoin?
Yeah, I mean, I think this happens in every cycle. When you think about it, remember, we had the dot-com boom of 1998 and 99, and then a lot of the things that were predicted in that dot-com boom came true, and you started to see them in the numbers around around human population around 2012. I think that's what technology takes. It takes about 15 years for something to go from being, roughly inevitable. This is how technological revolutions happen. They go from kind of being ideas that people think are inevitable, but it takes 15 years for us to climb that curve. So I think you'll see the same thing in the world of digital value. Bitcoin is now 15 years old. It has been, tested, beat up, run through the ringer, sort of knocked down, it had scams built around it, et cetera. And I think that if there was nothing there, we wouldn't be sitting here having this conversation today. And after 15 years, you have, the financial communities sort of recognizing that fact. I think it will happen with, over the same time horizon with many other things in the ecosystem. So I think a lot of the ideas that came as part of the boom of 2021, if we look ahead at 2035, some of those will be, will be things that are mainstream as well. It simply takes time for technological revolutions to take hold.
Ian, really quickly here, you mentioned the halving expected next month. How big of a catalyst do you expect that to be, not just for the price of Bitcoin, but for Ledger?
This is always hotly debated. The fact is that, this runs in cycles, and the halving is one of the things that is the, that is the marker of that cycle. There are other things. There's liquidity. In this case, we have the ETFs. I think this is going to be a gigantic year for all of us that are in the crypto space, and it already has been for Ledger, and I think it will be this year. We have, as people come in, they need security. They need self-custody. We say, if not self-custody, then why crypto? And I think that's, one of the, if not the key features, is what you have here is a new human invention, digital ownership. There's no question we will have more digital ownership in our lives tomorrow than we have today, and that goes from digital value to digital identity to to digital art and video games, et cetera. And if you have that, then you need security and you need ownership, and that's what we bring. So I think it'll be an incredible year for us.
Yeah, it's certainly great to get your perspective as we continue to watch this rally. Ian Rogers, Ledger Chief Experience Officer. Good to talk to you today.
Thanks for having me.
Well, crude prices are edging higher today. This coming after OPEC Plus announced plans to extend production cuts until June. For more on this, Yahoo Finance's Inez Ferre joins me with what to expect. I guess the extension was largely expected, but where do we go from here?
Yeah, that's right. The extension was expected, and part of that was priced into the crude prices that you're seeing, and they had been higher earlier. Right now, we are looking at prices
that are down a little bit, with WTI hovering around $79 a barrel. Last Friday, they went up above $80 a barrel for the first time this year, the first time since November of last year. And Brent crude, you're watching it at around 83 a barrel. Look, the market was anticipating that OPEC Plus was going to extend its production cuts. It will not unwind those production cuts easily if the floor is not around $80 per barrel for Brent crude. That's what analysts that I've spoken to have been saying. We have been seeing some tightness in the physical markets. The near-term contracts are more expensive. They're trading at a premium compared to the later months contracts, and that's called backwardation. I don't want to get too technical on you, but basically that means that the physical market is tight. And that's because of some of the issues that we've been seeing with the Red Sea, with refineries, and also this expectation that OPEC Plus would be extending its production cuts. But make no mistake, we have seen an ascent really with these prices over the last couple of months. In the last 2 months, February and January, gains for those months. Year to date, Brent is up more than 9%, WTI up more than 12%. And again, going forward, the market was expecting these extension cuts, and it's going to be difficult for them to cut them if the price is not maintained, if the floor price isn't maintained. Akiko.
Okay, Inez Ferre with the very latest on OPEC Plus. Thanks so much. Well, coming up on the other side, a busy week on deck with investors keeping a close watch on Fed Chair Powell, what he might say during his congressional testimony. We're going to be discussing that on the other side. We'll be right back. Federal Reserve Chair Jerome Powell testifying before Congress this week, set to discuss the state of the U.S. economy on Wednesday and Thursday. The testimony comes ahead of a key jobs report Friday. That report follows the latest reading on inflation, pointing to a mixed picture. Let's bring in Charles DeLara, Partners Group Chairman of the board and advisory partner, as well as former Assistant Secretary of the Treasury for International Affairs. He's here to discuss more. Charles, it's great to talk to you today. How would you characterize where the U.S. economy is today?
Kito, it's a pleasure to be with you this morning. I would suggest that we're at a very critical juncture with regard to sustaining the growth, which has continued in a much more robust fashion than we have anticipated, and many of us have anticipated, while also continuing the process of taming inflation. And this is not by any means a battle that has been won. Clearly, the jobs creation in January exceeded anyone's expectation, but also we're seeing, not surprisingly, a persistence in inflation that I think will be difficult to completely overcome. Therefore, it's not surprising at all for me to see the Fed playing his hand very cautiously, as I think it will have to over the next few months until more data evolve and until we see more clearly the picture here. You know, there's a lot of positive things happening, giving some good tailwinds to the U.S. economy, but there are also many challenges both in the U.S. and globally, and underscoring the vast amount of uncertainty that we're facing in the U.S. economy at the beginning of the year.
You talk specifically about the stickiness of inflation. When you look at what came out with PCE, which is the Fed's preferred inflation gauge, and CPI, a bit of a mixed picture here. PCE coming in line with expectations, CPI coming in hotter than expected. If we want to keep with the plane analogy we've been talking about with the soft landing, how concerning is this inflation? Is this just kind of the turbulence we expected on the way to the soft landing? Or does the latest data point to something that is a little more concerning?
Well, you know, I guess I'm in a minority. I don't believe that the analogy or the metaphor, if you want, of a soft landing is very appropriate at all. A soft landing implies that the passengers have had a smooth ride and they're just coming in for a soft landing. The passengers have not had a smooth ride at all, any more than the passengers on the Boeing jet where the door ripped off mid-flight had a smooth ride. So whether or not it's a soft landing, it seems to me, belies the reality that net prices have gone up 20% in the U.S. over the last 3 years. And the damage has been done in many ways to the earnings power of many, many American households. Virtually no indices that I've seen indicate that the average wage has kept pace with this 20% net increase in prices. The numbers are actually growing by the day. So I would perhaps be alone in disputing the analogy of a soft landing. And I think that is part of the challenge that politicians face today, wondering why the job creation hasn't created more optimism about the feeling of the economy. I do think that the experience that we've lived through in the past, and as a young Treasury officer in the U.S. Treasury in the late 70s and the early 80s, I lived through the last bout, or one of the most serious bouts we've had of controlling surging inflation, which occurred in the late 70s. And these processes are not linear. Even Paul Volcker found it challenging to find the right touch. He tightened monetary policy dramatically in the fall of '79, and he had to take his foot off the brake in the spring of 1980 because the economy was falling too rapidly. And then, lo and behold, inflation came back. I'm not saying we're going to see a repeat of that, and I think that the Fed is very cautious about taking their foot off the brake too early. But I think that markets have to be realistic and not expect that everything is smooth here as we try to bring down inflation to 2%. It simply is unlikely to play out that way, and therefore some degree of continued turbulence, I think, given particularly the uncertainties in global markets and global security issues, is bound to be expected.
I mean, that would seem to suggest that cautious picture you just pointed to would seem to suggest these rates need to remain where they are right now for a little longer. Are you in the camp that you don't think the Fed should or could cut rates at all this year?
Well, I think the odds are quite good that the Fed will cut rates this year, but I think it's unlikely, in my view, to be before June, and based on current data, could well be somewhat after that. I think that we face so many uncertainties. Yes, the U.S. economy is more robust than one had expected. There's job creation. Even that creates challenges for the Fed. Can they really rely upon inflation remaining low? I know that the favorite Fed index is coming down well, but that excludes food. What do people actually feel at the gas pump, at the grocery store? That's important to the overall reaction, important to the politics, important to the mood of consumers in this country. And those perspectives haven't been, I think, completely resolved. The concerns haven't been resolved. So although I do think we'll see a period of lower rates, I think that we now realize that either the Fed or, more importantly, the markets got a little bit ahead of themselves in the last 6 weeks or so of 2023. And now I think a little bit of realization that this process is not linear, that we could face more bumps in the road, is warranted by markets. That's not to suggest that the equity market performance cannot continue, but I seriously doubt that it will continue the way it has over the last 2 months or so.
Charles Delara, Partners Group Chairman of the Board and Advisory Partner. It's good to talk to you today. Really interesting to get your perspective. Appreciate the time.
Enjoyed being with you. Thank you.
Well, JetBlue and Spirit officially calling off that $3.8 billion merger. A federal judge initially blocking the attempt back in January, saying it would have too big an impact on the competition in the airline space. Let's bring in Mike Boyd, Boyd Group International President. Mike, it did seem inevitable after we saw the federal judge block that merger in January. Given where things are right now, I mean, what does this mean ultimately for the airline space, but more importantly, a company like Spirit, which has really struggled?
Yeah, well, listen, the judge was wrong. He didn't know what he was talking about. This would have freed up a lot of airplanes so JetBlue could have competed a lot more aggressively, and anything that was lost with Spirit would have been filled in. The judge just didn't know that. But like going forward, when we have a situation, this might be somewhat ameliorated by the fact that you have United Airlines is going to be about 100 airplanes short this summer. We're going to have other airlines with airplanes in maintenance like Spirit and whatnot. So it's not going to kill anything. I think long term it would have been a better deal. But both carriers are going to be able to prosper very well going forward. The consumer is really the one that loses here.
Yeah, so let's talk about Spirit Airlines here. That stock down roughly 14% right now. How do they prosper, as you say, moving forward?
Well, keep in mind, it's a very well-run company today, number one. Number two, they understand markets. The idea of just expand for the sake of expansion, they're out of Denver. They pulled out of Manchester, New Hampshire. They've added other routes. They're looking at places where they can make money. Remember, these low-cost carriers, these ultra-low-cost carriers, are no longer chasing Florida traffic. They're chasing traffic like from Grand Rapids to Dallas, places like that, where they're really trying to provide a lot more competition than they did before. I think Spirit's going to do very well there. Again, the consumer would have been done better if its 200 and some airplanes became JetBlue and started to compete a little heavier with the top four.
If you look at somebody like JetBlue, they were certainly hoping to use this merger as a way to compete on a bigger scale. Now they're back to being sort of in the second tier, if you will, of airlines behind the Uniteds, Deltas, and the Americans. Where do you think that they push the strategy forward? This merger is now out of the picture. Certainly doesn't look like there's other assets they can look to buy given the regulatory environment. How do they move forward?
Well, this would have leapfrogged the problem. They weren't getting Spirit's routes. They're getting airplanes equipped with pilots, if you will, which was really great. They can go ahead, but they have to go ahead a lot more slowly. They've got a great plan across the Atlantic. I mean, they have a mint product. They're going after a wider range of the population. They're very, very conservative in terms of like adding stuff into low fare or highly competitive, leisure markets. So I think they can go ahead. They would have been better with this, but right now, arguments that both they and Spirit are in trouble just really don't hold water. They're not in the rosiest of conditions right now, but neither is in really dire straits.
There's another merger in the works in the airline space, which is, of course, Alaska Airlines and Hawaiian. This was always sort of seen as two separate mergers, Alaska, Hawaiian being one that's may have an easier path to regulatory approval. Does what happened here with JetBlue and Spirit change that in any way? How do you think about that?
Two different deals entirely. What is happening with Alaska Hawaiian? Alaska basically is buying the stock of Hawaiian. They're not putting the two carriers together in terms of a marketing entity. They're combining some things. Hawaiian's always been on the edge, and the current management has gotten it off the edge, but it's still always going to be hard to make money when you're just competing just on one market, one trick pony, which is Hawaii. They've done a great job. Peter Ingram's done a wonderful job, but with this merger, they can bring down their overhead costs and spread it out with Alaska. There's not going to be a lot of synergies in terms of routes or flights or things like that, but the overhead costs and other things, it's going to be a winner for everyone involved, and it's going to also help the Hawaiian Islands. I would suspect the governor of Hawaii should be behind this 100%.
And finally, Mike, you said, you thought the judge was wrong in blocking this merger. You think ultimately it's the customer that gets hurt the most. How so?
Well, number one, if JetBlue could have expanded with those 200 and some airplanes and pilots, plus what was on order at Spirit, it would have given a run for the money in a lot of markets where the big four, United, Delta, American, and Southwest, are dominant. And that doesn't mean they're dominating markets or monopolizing it, but it does mean that JetBlue could have brought its high-quality product to a lot more consumers, and it wouldn't have necessarily hurt. Again, the trips that were lost to Orlando, someone else will pick that up. But the new service they could have had to places like Spokane or Bangor or places like that would have benefited the consumer because it would bring new competition to mainline flying, not just people who want to go on a cheap vacation.
Mike Boyd, Boyd Group International President. Appreciate you making the time today. Thanks so much for stopping by.
Thank you.
Well, coming up on the other side, Dune Part 2 spicing up the global box office market this weekend. But is it enough to brighten the year ahead for movie theaters? We're going to have more on this with our conversation with IMAX CEO Richard Gelfond on the other side. We'll be right back. Well, Dune Part 2 racking up nearly $82 million in ticket sales for its domestic debut. This marks the best opening weekend of the year and the biggest since Taylor Swift's The Eras Tour film last October. For more on how the 2024 box office is shaping up, let's bring in IMAX CEO Richard Gelfond, along with Yahoo Finance's Ali Canal. Richard, it's good to talk to you. We should point out IMAX sales providing a big bump to this film. I've read reports of 3 a.m. showings that were nearly sold out. A film that was shot entirely on an IMAX camera. I mean, what do you think this draw or this performance, at least in the first opening weekend here, what does that tell you about where the enthusiasm is within theaters right now?
There's no question that Dune 2 is going to have a lot of legs to it. The pattern is playing out very similar to Oppenheimer, which was filmed with IMAX cameras. It opened globally to a very similar number. It opened to extremely high IMAX indexing. For this film, IMAX was 18% of the world's box office on 0.8% of the screens and about 22.5% of the domestic box office. So it's a little bit like appointment viewing, meaning that people are going to wait to see it in IMAX, which Denis Villeneuve filmed the whole thing with IMAX cameras. And if you look at our pre-sales 2, 3, even 4 weeks out, there's no question this film is going to have legs and is really going to jumpstart the box office this year.
And Richard, this also seems like a full circle moment for theaters, considering this film was delayed from its original November date to March due to the Hollywood strikes. But we do have a group of Hollywood Teamsters, a separate union, IATSE, entering negotiations with studios today. They've threatened another strike if they're not able to reach a deal. So to put it bluntly, can the industry handle a third strike in a year if that were to come to fruition?
So, Ali, I think it's way too early to ask that question. As you said, they just started negotiations today. And if they didn't say, if it doesn't work out, we're going to go on strike, they give up all their bargaining position. I personally think the industry has seen enough trauma, both on the studio side and the exhibition side, and it would be self-destructive for all involved to let it develop into a strike. Obviously, we want the union to get fair wages. The studios in Hollywood needs to make a living. But it's bad enough following the pandemic that you had these twin strikes. And I've got to believe no one wants to have this kind of self-inflicted wound imposed on the industry.
So, Richard, what stage are we at when it comes to the recovery process from those strikes?
So I'm going to be a little out there, Ali. We know each other well, so you know that's not surprising. But I think the forecast this year for box office have been too conservative. I mean, I think it was easy when there were very few films the first 2 months of this year, for people to be pessimistic. But if you look at the numbers, given the first weekend of Dune, the box office is only down 13% year over year. And we've got 3 more weeks of Dune 2 to go. And then you have Godzilla versus Kong. After that, when you go through the year, you have Deadpool, which is tracking extremely well. You have Wicked, you have Joker, you have the prequel to The Lion King, the Twister. I mean, there's a ton of good films. So I think people overreacted to the shortage in the first 2 months. And I think the year is going to play out pretty similar to last year. For IMAX, we had our second best year ever last year because we're not an exhibitor, we're a technology licensed company, and people clearly want to see social events, particularly those filmed with IMAX cameras in IMAX. And I think this is the real beginning of the year, and I think it'll gain more traction than people are expecting.
Richard, we know CEOs don't often like to talk about their stock, but you on a recent earnings call talked about how you think IMAX's stock is really undervalued given the growth outlook. What do you think investors are missing right now about the IMAX story?
I think because there aren't a lot of comps in what we do. There aren't any. IMAX is a bit of a unicorn. We license film technology and we help facilitate filmmaking. We're trading at something like 7 times EBITDA, which is ridiculous for a company that had the kind of growth we had year over year. And we just issued guidance for this year for continued growth. Our network is expanding fairly rapidly. We added 128 new installs last year. For this year, we guided from 120 to 150. There's also a very important thing going on just beneath the surface, and that is Oppenheimer, obviously, is a huge success, and IMAX did over $180 million in that. Now you have Dune, also filmed with IMAX cameras, and we do 22.5% of opening weekend and headed in the Oppenheimer direction. There are a lot of films, I think the majority of films coming out for 2025 that are being filmed with IMAX cameras, both film cameras and digital cameras. So I think the market share gains that we're having and the increased indexing is a precursor of a lot of good things to come, including network growth. And I think the public is just confusing that with a different model, which is exhibition, which has high fixed costs. We're an asset-light model. I just think they're not focusing on it.
And Richard, another big part of the IMAX story is local language films. And you talked about on the earnings call the recovery in the markets in China. You said you're overall positive, but there's still a few variables that have to sort themselves out. In your view, what are those variables and how can China get back to the place where it was?
Well, you put your finger on what the biggest variable was, Ali, which is China, which we came back a lot. We did over $300 million in box office there last year, but it was the first year out of COVID. This summer is very promising. We have 4 films in China this year that are filming with IMAX cameras, and I also think they'll over-index. But also last year, over 20% of our box office was local language films. So that was things like Japanese anime, not only in Japan, but in the US and in the Netherlands. It was Indian films. It was Korean films. And this year was slated to have more than 100 films. So I think people look at the domestic box office and they say, well, the first month was bad because of the strike. But IMAX provides awe-inspiring experiences on a global basis. And it's a completely different business model than exhibition. And we just have to continue to show that with our financial results as we did last year.
IMAX CEO Richard Gelfond, always good to have you on this show. And our thanks to Ali Connell as well as joining in on the conversation. Thanks so much.
Thanks.
Well, Ford reported its U.S. sales are up 10.5% year on year in February, led by increases in hybrids and EV sales. Let's bring in our very own Praz Subramanian with a breakdown of the numbers. Some positive news on the EV front, Praz.
Yeah, for Ford at least, we saw, Ford sales charging higher here in February. You noted that 10.5% jump, but also want to say that those hybrid sales were up 31.5%, mostly powered by the Maverick compact hybrid pickup. That truck is doing very well, as well as the Ford Escape small hybrid. So that's also doing well here. But yes, EV sales up 80% year over year. Now it's only 6,000 units or thereabouts. So that's still pretty good, but nonetheless, a long way to go. But interestingly with truck sales, F-150 sales were down month over month there. This is because of the fact that the model year 2024 F-150 was not ready yet. They're slowly ramping up sales of that. But over the last 2 months, Ford says overall truck sales are making it the #1 U.S. truck seller in the U.S. there, ahead of the Chevy Silverado. But I want to note that this also follows strong sales from Honda, Kia, Hyundai. So we're seeing that in Toyota too. Even though Toyota was second behind Ford, they also had a strong sales month compared to year over year. So it makes me think that not only are the product portfolios good, but also perhaps the U.S. economy stronger than we think it is.
And shares of Ford getting a big bump on the back of those numbers, up about 4.3%. Praz Subramanian, thanks so much.
Thanks, Kiko.
Well, coming up on the other side, we're going to give you a preview of Target's earnings. More to come here on Yahoo Finance. We'll be right back. Investors are looking ahead to key results from Target before the bell on Tuesday. For more insight into the state of the consumer, here with what to watch, we've got Yahoo Finance's Brooke DePalma with a preview. Brooke.
Good morning, Akiko. That's right. Target expected to report before the market opened on Tuesday, and Wall Street expecting here another quarter of sales decline. Earnings per share expected to come in at $2.40. Same-store sales expected to come in down 4.5% as in-store sales continue to drag that lower. Now, three items that Wall Street is keeping a closer eye on. First up is sales remaining to be challenged. Now, we did mention that same-store sales are expected to be down 4.5%. Softer sales numbers are largely due to weaker traffic, softer consumer spending, as well as moderation in inflation. Now, that could be offset by those sales of essentials, grocery, and beauty products, a bright spot that we've been following over the past year. Now, second on our list is this idea of value perception. Investors and analysts really keeping a close eye on how that updates its value offerings and merchandising investments have played out for Target. They did focus on new items with 10,000 added during the holidays and value with many items under $20. Also, the performance of its new private label brands, something that Target has really been leaning into as of late. And lastly, investors keeping a close eye on continued upside to gross margin. Opportunities there include improvements to supply chain, a potential mixed tailwind as less spending on electronics passes as more sales on beauty. In addition to that, lower clearance levels as well as leaner inventory is something that the street is hoping for, but this all could be offset by higher shrink. Of course, that includes retail theft, organized crime, damage, vendor fraud, as well as other factors that Target led to close 9 stores back in October. They claimed that higher shrinkage as well as retail theft caused them to close those 9 stores. And all of this while Target is also set to hold its annual meeting tomorrow. They call it the Financial Community Meeting, and there many expecting to get an update on store formats and how it's all working out for Target, with Drive Up as well as Target Plus really coming into play.
Okay, a lot to process, a lot of announcements coming through from Target, which, by the way, has lagged behind main competitor Walmart in terms of the stock. Brooke DePalma, thanks so much for that. Let's do a final check of the markets before we let you go. We are seeing red arrows across the board still. The S&P 500, though, trading pretty flat right now. The Dow down 77 points and the Nasdaq down 33 as we head into the noon hour. Let's do a check of where bond yields are trading right now. Green arrows across the board on that front in terms of the yield curve on the benchmark 10-year yield right now at 4.217. That does it for me in the 11 a.m. Eastern hour. Much more to come here on Yahoo Finance. Keep it right here.